basically what happened is 87, there were a series of events, just like any crash. It's usually a sequence of events or a confluence of events that leads to the crash. And we're not in that situation today. So I could go through item by item, but there were a lot of things going on then that are different than today. And so my answer takeaway from that is no, we are not set up for something like that. The likelihood of that same sequence coming together is actually quite rare. So that's what my take on that.
All right, so you said, just before we move on to today's market, you said one factor in the crash of 87 was computerized trading. It was relatively new then. It's very commonplace now. A lot of times when we see big sell-offs, we say, oh, that's the algorithms. Could that lead to, you're saying it's not going to happen exactly like it happened in 87, but anything similar these days?
Well, generally trading, since 82, trading has become a much larger part of the market. In the past, trading really was there to support investing. And so you develop derivatives, and one of the terms you'll hear a lot about 87 was a thing called portfolio insurance. So there were computer-driven models that were using dynamic hedging. Today, I would say it's much more, or in those days prior to 82, it's much more, I would say, the way Jim Cramer talks about trading, which is to support investing. So you have a good idea, you have something you want to own, and you want to purchase it wisely, or you want to sell it wisely. But the purchasing and the selling is not the point. The investing is the point, and the trading supports that. That was prior to 82. Since then, more and more and more, the trading has become the focus of many people's activity. So Warren Buffett said in his annual meeting this year, he's never seen so much gambling in the market. So that's kind of what's going on in the market right now. But that portfolio insurance was computer-driven, dynamic hedging, and that certainly contributed to the 87 crash. You got to remember, that year, the market was still positive. So shortly after that Black Monday, the market started going up again.
All right, so how you position your portfolio today, 35 years later after that big crash? We have a lot of inflation. We have rising rates, 10-year yield above 4% as we speak.
Yeah, the 10-year yield above 4% is hard to live through. The point I would say, because of where it came from. But having a positive 10-year yield is a very good thing in portfolio construction. We've gone through 10 years here where bonds were not an effective tool. So if we can have a real yield on the 10-year and rely on that, that's a constructive thing. You can't predict what's going to happen in the market. You can only prepare. So how do you prepare? You own a lot of assets that you believe in. And that 87 crash was a very short thing. My view is that this decade we're in right now is more likely, you can't predict, but more likely to look like something that was 72 to 82. In other words, a 10-year period that was hard and flat. And what I think we're trying to see right now is people are saying, how do we get back to what they think is normal, which was 2019? And that isn't normal. This is more like normal. So stay diversified, make good decisions, think long term. That's investing.